Let's get this episode of Navigating the Markets fired off. It is Monday, September 30th, 2024, and we've got a lot of coverage. So let's first go through the risk disclosure real quick here. All trades and investments involve the risk of financial loss. The value of positions can go down as well as up. Past performance does not guarantee or predict future results. So the first thing I want to do is walk through some heat maps here because I think it's really interesting what's been going on. So we're going to do a day, a week, a month, and a quarter to go through this rotational flow that is happening in the markets. And if you weren't really paying attention to it, it's happened sort of progressively over time, so you almost could have missed it. Here's today's heat map. You'll notice Apple was really the leader in tech, but it was a pretty decently green heat map across other parts of the market where we've seen leadership start to emerge in the inglorious 493, so to speak. Here's the last week where you could see more sort of that rotational flow. There's more diverse participation in upside, but it really starts to become more striking over longer time frames. So here's a month. And we can see this is a pretty bright green heat map with a lot of participation from industrials, real estate, utilities, basic materials, financials, consumer defensives, and cyclicals. And then finally, the most striking heat map, the quarter. So basically, in the third quarter of this year, tech did nothing. Semiconductors, outside of NVIDIA, a lot of them sold down a bit. And the rest of the market was well bid. This goes to that theory we've talked about for some time that there would be this rotation favoring equal weight over market cap, favoring value over growth, favoring low volatility over high beta. And to some extent, that is certainly playing out. So that is something to keep an eye on here as we navigate through the rest of the year, because I do believe that's something that is set to continue. This idea that we could see some of the other parts of the market, the lesser loved parts of the market, as I like to call them, get some attention here. So that means that there could be setups in areas that we're not really necessarily playing as much, like technology, that, I think is worth looking at as we go on. So that means looking into some of these areas that are showing relative strength versus the broader S&P, or just some of those pair trades that we've talked about for some time, like RSP versus SPY, or SPLV versus SPHB, or SPHD versus SPY, or some of the growth versus value trades and otherwise. And in essence, it gives us a sense that if this rally continues to broaden out, we could see a different look for the next leg of this bull market. So let's quickly zoom in a little bit to some of these pivots. These are generated with the dynamic pivots tool. It looks at volume profile over a pretty decent time frame and automatically generates pivots that can be actionable for near-term traders. So for now, as long as we remain above 57.8875, I am more inclined to be bullish of the S&P. Although if we do start to move below 57.6825 and build some acceptance there, I would be looking for fade trades. So above 57.8875, I still think we can run to the upside. Below 57.6825, and I'd be looking for some shorts and for taking profit. The NASDAQ has a pretty similar setup here, above 202.0775, and I'm still looking for long continuation. Below 20,091.50, and I'm looking for some fades here. Now let's zoom this out to the options chain on the S&P 500, because interestingly enough, you can see a kind of similar look here as well. Basically, above 5,700, and you can still be somewhat constructive on this market, but especially above 5,750, which has become a really key level of options-driven support for this market. You can see it's the largest level of gamma exposure on the entire chain. And then the reason that I'm looking at 5,700 with so much interest is that is just about where the gamma flip level is. And so as long as we're remaining above that, when you backtest being in positive gamma, you tend to see more constructive price trends in that environment. So for now, I am looking at the market constructively, and as long as we're above SPX 5700 in positive gamma, I think we can still be constructive on swings and day trades. We're also seeing hedging coming down a bit here as skew drops from its all-time high set recently. And this is a good sign. This is pretty much exactly what you want to see in skew. So everything that we see so far here looks pretty constructive. And we're going to be getting back into that period of time where those passive decay flows bid the market back up. But we're not quite there yet. Now let's shift gears over to China. China is at a key inflection point here. And you can see with all the headlines that we've had and all the really interesting sort of price action that's gone on in China so far, we're still below some very key resistance in FXI around 32.83. So China's on holiday basically until next Tuesday, right? That's their national holiday week. And there's not necessarily going to be a lot that's decided by the government or the markets until that time. So we've got about a week to kind of sit back, look at what's happened. If we're eager to get long some of these stocks, maybe making a shopping list of those and researching them. But for now, unless and until we build above 32.83, ideally on a weekly closing basis, and this is a monthly chart here, I'm not inclined to get too bulled up yet. And the reason that I say that is the amount of call buying that's happened in China has been absolutely bonkers. FXI, I believe, set an all-time high, but you also see that in A-shares margin buying. You see it in hedge fund flows. Just everyone's rushing into these stocks, whether it's to cover shorts, gain long exposure, whether it's a trade, an investment, or whatever the case may be. This looks a little exhaustive in the near term. So we've got about a week to let the chips fall where they may. And as we know, again, FXI is at a really key inflection point here. So we're going to get to watch and see how that plays out. So far, we've closed below that level and we're rejected there right on the nose, that 32.83. Now let's go through some of the mega caps as well, because we have this very interesting mixed picture in the mega caps so far. Apple is flirting with major resistance right here around 233.08, right? And we've seen that level play a role as resistance several times now in rallies. And the last times that it's played a role as resistance here, it's been an area where we typically either sell down or we head fake above and then sell down. But again, the more we knock on a key level of resistance, the more likely it becomes that we break it, particularly from a higher low, which we're at right now. So the setup in Apple being one of the most pivotal stocks in the NASDAQ and S&P based on its enormous market cap weighting is very interesting here. Amazon, on the other hand, does not look quite as inspiring. It was rejected at a key area of what could have become support, but is now resistance again around 191.63. Now it's testing that 20-day moving average point of control convergence area. This is an area that I like to watch this week, that low around 186.33 to 185.40, and then the high of 191.63. I think that we're in a pretty interesting, decisive point for Amazon. It had a head and shoulders breakdown into August. It rebounded very nicely from that low, just around 150 and change. And we've made up about, what, $45 from those lows? So now is a time for us to get a little bit more serious as to whether this rally has staying power. The structure looks constructive overall, lower. We got all away from that period of breaking down. So now we have higher lows and higher highs. But what happens at the point of control in 20-day, I think will be really important for Amazon right now. And it is still at a lower high versus the highs we saw in July. So that's another area to take into consideration. Microsoft often reacts pretty violently to the 20-day. As you can see on this chart, I've used the yellow circle to circle every time it either broke below or broke above the 20-day moving average. And it seems like every time there's a break below or above, there's a decent reaction in this stock. Why does it matter now? Because we're hovering right above that level. So if we hold it, I think that'll be very constructive for the bulls. It will put in a higher low, and we have that potential to continue back up to some of the recent highs we saw over the summer. On the other hand, if we do get rejected there, it's likely we revisit the point of control and possibly continue lower if this is like other breaks below the 20-day. Alphabet or Google or whatever we're calling them these days is also testing a key resistance area. So that's a bit of a theme that we're seeing here, testing these key areas of support and resistance inside these mega cap stocks. So I'd be watching this 166.21 and 168.31 level on Google. I think both levels are really important to the buyers here. If they're able to break above both pretty decisively, I think we can continue up pretty much right up to 175. Like, it should be a pretty short trip right back up there, and then we may consolidate for a bit. As we can see through May until late June, that was an area where folks just like to transact in this stock. So we could certainly get pulled back into that area and consolidate a bit. But for now, it's key as to whether or not we're able to build above and get some acceptance here, or whether we get pulled back into that point of control and lower volume node. So for all of these stocks, they're at pretty key inflection points. That's a bit of a theme, whether it's FXI, Microsoft, NVIDIA. All these stocks are kind of in these areas. And speaking of NVIDIA, this is another one that's at a pretty key area. It got rejected again at this descending trend line. It had this sort of head fake look above. Folks got pretty excited, but it couldn't even hold on to those gains for the day. And now we're rejecting lower, perhaps set to retest that 20-day moving average. Like Microsoft, NVIDIA also tends to react pretty strongly as to whether it's above or below that 20-day simple moving average. So it's one to keep on the charts, as is this descending trend line, because I think those are the two key levels to watch for how the market decides how it wants to move from here. Overall, NVIDIA's chart looks more bullish than bearish, but I'm not a huge fan of that rejection here. So I'd like to see buyers take it right back up above it if we're going to continue to the upside. Tesla, just like a lot of the rest of these stocks, also testing a key area here. This is the theme of the night. And so you can see right now, we've got this 263.41 area of resistance, and we've tested it. We've rejected from it for now, but tomorrow is another day. NVIDIA and Tesla are hugely driven by options flow. So I'd be keeping a big eye on those flows going into the rest of this week to see how yet another pivotal chart is decided going into the third quarter. And then there's Bitcoin, and Bitcoin, like NVIDIA, kind of loves to head fake us. So we can see another stock with this descending trend line, another head fake look above, and it was rejected today. So a little later than NVIDIA's rejection, but a similar look here. And what it's telling us is some of these risk appetites are fading just a little bit here during some key tests. And then finally, there's Triple Q. Now, Triple Q of the pack is looking pretty decent. The composite, the NASDAQ 100, which is really a large and mega cap tech composite at this point, it's seeing resistance around 491.24, and it's seeing support around 484.87. As long as we're holding above that 484.87 level, I'm constructive on the NASDAQ because it really fought hard to get above that level. It tells you when we are in this sort of low volume chop zone that we're in now, we're doing some consolidation and testing, potentially trying to move higher from here, or at least we see buyers aggressively defending that level. Once again today, they stepped in and defended that level too. Now, the NASDAQ new highs versus new lows aren't really that inspiring. Again, this goes to the earlier charts I showed, and if you didn't catch the whole thing, the recording will be out in about an hour or so. But essentially what we see is that new highs are not really growing in the NASDAQ. And the reason I present this chart is because if we were seeing a broadening out in tech, this chart would look a lot more like the next chart, which is of that of the New York Stock Exchange. The new highs in the New York Stock Exchange look much better, and this is that broadening out to the lesser love 493 sectors outside of tech like utilities, finance, real estate, consumer cyclicals. They're doing really well this year. In fact, they're outperforming tech this year. So that's where the money is rotating. That's where there's still opportunity. But I would put just a note of caution in for the near term. And that is to say that in the near term, there are some signs of exhaustion in the New York Stock Exchange here. So we're still above 70% of stocks above their 20-day moving average. As long as we're above that level, it's like a yellow flag. It tells me that there is some chance that we could sort of consolidate or drift lower or maybe even correct because there's just been so much upside momentum that it's become a little bit exhaustive. Now let's shift gears to another market that's showing some upside exhaustion, and that is gold. Chinese funds supercharged gold's rally. We've also seen enormous amounts of call buying in GLD, SLV, GDX, and some of the miners. So I think in the near term, we are seeing some signs that this rally could pause for a bit, maybe correct a little bit, but I don't think it's over the intermediate term. Another reason that I say that is because we are back in a world of easy money. This is the biggest month of monetary easing since April of 2020. So we are now seeing enormous amounts of cuts, 21 cuts during the month of September across the globe. And that's likely to set as, or continue really, that's set to continue as this year goes on and as we go into next year. So let me bring you to my favorite chart of gold. That's the Bollinger Band squeeze breakout. It is still in progress. It's still hugging that upper Bollinger Band. Volatility of price is still expanding. So in an intermediate term trade, from a very long-term perspective, gold still seems like it's on track to continue delivering that positive momentum. We could still pull back and consolidate in the near term, but as long as we see that Bollinger Band width, that top chart, expanding, that tells me that this is still a squeeze in progress. And this is not a short squeeze, it's a Bollinger Band squeeze breakout, right? So we're breaking out, and that's what that increased price volatility is also showing us. Now, the question is silver next? So silver has seen its squeeze. That's something that we had happen here, and you could see it in the Bollinger Bandwidth above. Now we're starting to expand. And if that continues, if we can see that expansion get up to the 60s and 70s and 80s of bandwidth, I think that'll be a sign that silver is really ready to rocket higher. So for now, I'm still guarded on silver because half of its demand is really industrial driven, and that's been a little bit lackluster. China's a really important part of that, obviously. So we do need to see some continuation to new highs, but overall, I am looking at silver very carefully here because I think there could be some opportunities in this because, again, we're in a path of global central bank easing, and that seems to be in its earlier stages here, that easing cycle around the world. As long as commodities don't get too heated, as long as inflation doesn't get too heated, that cycle's likely to continue in the near to intermediate term. Now, here's another thing that could ramp up some prices, especially around the East Coast of the United States, but there could be some beneficiaries to this as well. The East Coast port strike could happen as early as this evening, as if no agreement is reached. As of the time of making this slide, I didn't have any news that an agreement had been reached. And that tells us that there could be some opportunities in freight, in rail, and in trucking. So I think it's time to look at some of the shipping stocks, some of the rail and trucking stocks that could be beneficiaries of this. It could also, interestingly enough, boost energy prices because you're talking about having to move cargo around the country a lot more than you were ordinarily. So that basically makes it less efficient to do so. It's going to cost more energy to move things around. So that could bid up diesel. It could bid up West Texas Intermediate crude a bit as well. So let's recap here. China feels euphoric after a major pop ahead of their holiday break. There's a mixed picture in the mega caps and NASDAQ. The New York Stock Exchange looks better, part of a broadening market theme. And near term, things could be a bit bumpy in the stock market. There are some signs of exhaustion. And we are back to a world of central bank easing, which means gold and silver seems set to continue moving higher over the intermediate term. And finally, a port strike could boost shipping, truckers, and rails. That concludes this episode of Navigating the Markets. I want to thank you all for tuning in. I hope this was really helpful to you all. And of course, a recording will be posted shortly after I wrap up. And if you have any questions, just let me know. Fire them off into the questions room or in my replies or otherwise. Thanks, everyone. I'll catch you next time.